The Producer Price Index, or PPI, is a crucial economic indicator. It measures the average change in selling prices received by domestic producers for their goods and services over time. Think of it as a barometer for wholesale prices. The PPI tracks various stages of production, from raw materials to intermediate goods and finally, to finished products. Why should investors care about the PPI? Because it provides valuable insights into inflationary pressures at the producer level. Rising PPI can signal potential price increases for consumers down the line, impacting everything from your morning coffee to the cost of a new car. Essentially, the PPI offers a sneak peek into future inflation trends, which can significantly influence investment decisions. By understanding the PPI, investors can better position themselves to navigate the ever-changing economic landscape. The January 2025 PPI report delivered a dose of reality to investors hoping for easing inflation. The headline PPI figure exceeded expectations, rising by 0.4% for the month. This increase, while seemingly small, points to persistent inflationary pressures in the production pipeline. Core PPI, which excludes volatile food and energy prices, also rose by 0.3%, matching forecasts. While this might appear less concerning, it still indicates underlying price pressures across a broader range of goods and services. These higher-than-anticipated PPI numbers have significant implications for inflation. They suggest that businesses are still grappling with elevated input costs, which they may pass on to consumers in the form of higher prices. This, in turn, could fuel further inflationary pressures in the economy. The January 2025 PPI report sends a clear message to investors. Inflation is stickier than initially anticipated. This has profound implications for investment strategies across various asset classes. For starters, the Federal Reserve, the central bank of the United States, closely monitors inflation indicators like the PPI. The higher-than-expected PPI figures make it less likely that the Fed will cut interest rates in the near term. In fact, the Fed might even consider further interest rate hikes to combat inflation. Rising interest rates tend to impact various sectors differently. For instance, growth stocks, often found in sectors like technology, are typically more sensitive to interest rate increases. On the other hand, value stocks, which are often found in more established industries, might be less affected by rate hikes. From an ethical and Islamic finance perspective, the PPI report underscores the importance of investing in companies that demonstrate social responsibility and ethical business practices. Islamic finance, guided by Sharia principles, prohibits investments in sectors deemed harmful, such as alcohol, tobacco, and gambling. Investing ethically often involves considering environmental, social, and governance (ESG) factors alongside financial returns. Companies committed to sustainable practices and fair labor standards may be better positioned to navigate inflationary pressures and supply chain disruptions, potentially making them more attractive investments in the long run. Furthermore, Islamic finance promotes profit-sharing and risk-sharing models, such as mudaraba and musharaka, which can offer investors alternative avenues for navigating volatile market conditions. By aligning investments with ethical values and Islamic principles, investors can strive for financial returns while contributing to a more just and equitable society.